but I'm uncomfortably long gold for the reasons you just articulated. I hope that this is the one time in history where a currency is printed with reckless abandon and entitlement promises are made that can never be fulfilled, and debt increases at an exponential rate, and interest payments on said debt surpass the total defense spending of the country, and yet it all works out okay. And look, I'd be happy with that. Like, but that's doesn't seem likely from where you and I stand today.
Seems a going to shift us over to commodities and begin with oil. Given the recent geopolitical developments that we've been discussing and the shifts in global demand, how do you anticipate oil prices will trend over the next 12 to 18 months?
So we like to observe the price of oil through the lens of where should it be trading based on the physical markets. And there are ways to do that, especially when the physical markets for the other primary energy commodities are relatively well balanced. And that's certainly the case for natural gas and coal today. And so one sort of thumb in the air estimate of where oil should be trading is to take the price of landed LNG in Europe or Asia and multiply by 6, because that mostly corrects for energy content. And so today, liquefied natural gas can be acquired. A Dutch TTF contract is $10 a million BTU. So you multiply that number by 6, you get $60 a barrel of oil. And oil's trading for 80 today. Now, that gap between LNG times 6 and oil was as high as 35 at the peak of the geopolitical crisis when the missiles were being lobbed from Iran and the Israelis were getting ready for their counterattack. Now, one of the interesting things you saw is that alligator jaws began to close immediately once the Iranians tweeted that this was the end of the war in their view before the missiles had even landed, which sort of implied that it was perhaps more theater than war. But nonetheless, we think if peace broke out, we would see oil trading sub 60 relatively quickly. And so there is probably a $20 to $25 a barrel risk premium in the price of oil. And then, of course, the challenge and the reason why that premium exists is because if we do see an unintended escalation, you could see $150 or $200 overnight. And so it's not like you should be shorting oil because there's a risk premium. That risk premium is the market's best effort to adjudicate on where oil should be, given all of the tensions we see, in the Middle East and in the shipping lanes and so on. And so we watch that ratio. We watch that alligator jaw and see, for several months this summer, they were trading roughly in line with each other. 6 times LNG was roughly the price of Brent. And then the war broke out in Israel, and it stayed pretty tight. And then when it seemed like the war might actually escalate, you started to see this spread. And it jumped out to like $35 a barrel, which is pretty high. And that peaked again on the day that Iran launched those couple of hundred missiles and drones into Israel.
So you think it's going to remain fairly steady, assuming there's no escalation in geopolitical, problems?
Yeah,
we'll stay in this range.
Yeah, so the sweet spot price we should also say, look, oil is not a natural price discovery market. OPEC, for example, actively tries to manipulate and manage the price of oil. There are many interested parties who manipulate things like production, available for sale, inventory levels, the strategic petroleum reserves. It's not like the U.S. is the only country that has one. So oil is not a natural market. It's the world's most important market, but it is heavily influenced by state actors who oftentimes have things beyond economic interest at stake. And so the sweet spot price for OPEC is between $70 and $90 a barrel. And if you look at the chart in the last 18 months, we've been basically range bound between those two extremes. Absent the geopolitical tensions, I think it would be very difficult for OPEC to keep the price above 70, although they would try. There's only so much they can cut. And when of course they can cut a lot, but the realities of their needs to fund their national budgets through the sale and revenue that comes with oil means that the discipline usually tends to break on the low end of these ranges. The geopolitical risk premium embedded in the price of oil today is saving OPEC from having to make such tough decisions. But if suddenly oil was $65 or $60, I think you'd begin to see some people break. And so, there's several million barrels a day of excess capacity that is currently proactively and voluntarily being kept out of the markets by OPEC today.
Yeah.
Now, and again, we should say at $70 to $90 a barrel oil on an inflation-adjusted basis in 1980 dollars, that's $25 a barrel. Oil is dirt cheap today. Wow. It's an incredible resource. Look at natural gas in the U.S. I mean, look, it's beginning. I think the bottom is in natural gas in the U.S. We're going to see engine switching. We're going to see CNG engines taking over from diesel engines because it doesn't make sense to pay for diesel when you could have free gas. But over time, that's going to equilibrate. But right now, at $2 a million BTU Henry Hub, that's $12 a barrel oil. That's cheap. Hydrocarbons are cheap. Yeah. I mean, and by the way, they're very useful.
Very useful. So over the last 10 years, Doomberg, more than 1 billion iPhones have been made in Chinese power plants that are powered by coal. We've exported our carbon guilt to China while at the same time harming job prospects in the Rust Belt. And we've created really an uneven playing field for American companies. It doesn't seem like a sustainable path. Carbon reduction goals are extremely commendable, but impossible without China playing a more constructive role. Yet in 2022, they built 6 times as many new coal plants as the rest of the world combined. And it's continuing their permitting spree. So the coal power capacity has risen something like 30% since just 2022. So clearly coal is not going to be phased out in our lifetimes. Oil usage is rising. Coal usage is rising. Uranium usage is rising. Nat gas usage is rising. Global energy needs are just rising across the board. It's taking everything the world has to meet the needs. What do you see for the energy future? Is it more of the same, where all energy forms are going to be rising in demand, or one's going to become more of a winner over the others, and the others are going to begin to fade downward? What do you see? And the other part of the question is, do you expect energy to mean revert as a percentage of investment as a part of the S&P 500, as it's below the mean currently?
Yeah. So look, energy is life. All humans everywhere want a higher standard of living, and you can't impose order on your local environment without wasting heat. This is like thermodynamics. The human endeavor is a constant, unrelenting struggle against the forces of entropy. And your standard of living is literally defined by how much energy you get to harvest and use to waste heat in order to increase the order of your local environment. We have developed what we call Doomberg's postulate, which states that every molecule of fossil fuels produced will be burned by somebody somewhere, and local restrictions against such activities merely change who gets to enjoy that privilege. What do I mean by that? Every ton of coal is going to get burned by somebody somewhere. And if coal is outlawed in Europe, it's just going to make it marginally cheaper for the Indonesians to burn it, or the Pakistanis to burn it, or the Indians to burn it, or the Chinese to burn it. If you outlaw fossil fuels in a country, if Ireland decides that nobody's allowed to buy gasoline or diesel anymore, guess what? The emerging world will greedily lap up that incremental supply at slightly lower prices and burn it. And so the thing that is the gating function to carbon emissions is fossil fuel production, not demand. And Europe doesn't produce any, for example. Like Europe produces no natural gas or oil to speak of, and barely any coal. Nobody cares what Europe does, or how many wind turbines they install, or how many solar panels they install. It's not going to affect the arc of carbon emissions, because if there's a fossil fuel to be burned, somebody's going to do it. And who are we to tell them not to develop? Look, if you look at the global south, the 7 billion people not in the G7, they exist at a fraction of our BTU per capita that we do. And everybody wants to climb Maslow's hierarchy of needs. Like, who are we to tell the people of the developing world that they cannot and should not provide a better standard of living for their families because of climate change? They're not even going to care. I've been around the world. Like, I've been to India, I've been to Mumbai, I've been to Brazil, I've been to Sao Paulo. I've been to Mexico. Like, these people don't care about climate change. They care about the next meal and clean water and getting an education for their family. Like, they're no different than you and me. I mean, we're just operating on a different scale. We're very blessed. Look, we couldn't be more privileged. We won the global lottery. We were born in the right place. I never allow myself to forget that, having seen the world. They're going to develop. Unless we're going to stop Indonesia from producing coal, unless we're going to stop South Africa from burning coal and producing its own coal, whatever we produce will get burned. And it blows my mind that people can't see that. Like, the world doesn't care what Ireland does. So why should Ireland care what Ireland does? Like, get about it. Get yours.
So do you see the various forms of energy as a whole rising as a percentage of the S&P 500?
Yeah. So I can't tell you what Wall Street values and why. So our investment philosophy, which I alluded to earlier, is we earn money in fiat. We live in the fiat world. Pay our taxes, all those nice things. We save money by buying real assets, and we personally prefer to invest privately where we can affect the outcome, where we know management, we can bring our network to bear, our expertise to bear, our funding matters, pick your favorite. We try not to participate too much in the public markets, and that's actually beneficial to writing Doomberg, because then we can write freely about things and people don't assume we're just talking our books.
Yeah, that's a good philosophy.
And we have had good success in the private markets, which is not for everybody. It's its own world, its own ecosystem, which we could talk about for hours. So I don't know why it is that cash-producing coal companies are selling for 3 times free cash flow. It seems like a good deal to me, but it just is what it's like. Buying tobacco companies and holding for dividends was like the investment of a lifetime 20 years ago. But that's not for me to opine on. There are people who know much more about these things than I do. I don't know why the single most important sector is the least valued in the stock market and the most denigrated. Look, the heroes who work in the fossil fuel industry are the reason why the lights come on when you flick a switch. Like, let's not kid ourselves. They're the reason why we can buy cheap clothing and Amazon can afford to put gas in the vans that deliver your toiletries a day after you order them with a click of a mouse, which is also made of fossil fuels. Like, the fact that the scores of thousands of brilliant scientists and engineers and lab technicians and field workers who do the dizzying array of work that make modern life possible are amongst the least popular people in our society is a great mystery of our time.
It is. It really is. So I appreciate everything you just said there. Doomberg, I mentioned uranium a moment ago. What is your uranium thesis currently?
We are structurally bullish nuclear power, which means, given that there are very few ways to express such a view, that the commodity itself probably has tailwind to it. I think the supply chain is a little more complex in the sense that enrichment, it can be a bit of a bottleneck, especially in the aftermath of, again, another stupid sanctions policy where we've decided to ban the import of enriched uranium from Russia. So you could see unenriched uranium actually get clogged, as it's just like oil prices generally go down when a refinery explodes. Gasoline and diesel go up, but the price of oil goes down because you kind of have this bottleneck in the system. But by and large, all things being equal, we think we are in the midst of a nuclear renaissance. There is no path to any meaningful decarbonization, if such a thing even exists, that does not squarely involve nuclear power. I think we're beginning to see the literal dying off of the old school Malthusian anti-nuclear environmental radicals. And in their place are ever more pragmatic and realistic people who, if they genuinely care about carbon emissions, then they shouldn't be anti-nuclear. Those are two incongruent positions that we believe can't be held simultaneously. And the other thing about uranium, unlike natural gas and oil and coal, is the price of uranium could triple and nobody would care. Like, it's such a de minimis input into the price of electricity at a nuclear power plant that $300 a pound uranium it's going to raise a few eyebrows, and it's going to impact the margins of power producers, but it's not the same as natural gas in the US going to $20 a million BTU, which would be a catastrophe. And so there's room to run for uranium. I think the break-even price for the cost curve of incremental mining supply is around where we are today, somewhere in the mid-90s, I think we are, last I saw, dollars per pound of uranium. So there's room for upside. Markets are, nothing goes straight up. I was pretty cautious on uranium a few months ago when it was hitting what our friend Tony Greer would call its Icarus print. Nothing goes straight up vertically, exponentially, indefinitely. And I think a little bit of a pullback and consolidation in uranium is relatively healthy.
Yeah. Well, that's a good overview. I appreciate that. Let's discuss gold. Central banks had owned about 70% of their reserves in gold for decades until the 80s, and then it dropped to about 15%. U.S. Treasuries took center stage. That's all now reversing higher as central banks are, moving towards gold. They want a more secure reserve asset. Do you see this as a new multi-decade trend, reversing back to the 70s levels? Do you see it more like, well, the U.S. is just trying to, work to deal with its current high debt levels, and the foreign nations are watching to see how the U.S. deals with that, but that'll just play out, and then we'll get back to, business as usual with the treasuries? In other words, is the move by central banks to buy historic amounts of gold in lieu of treasuries a new trend is your friend, raising the floor for gold?
I do think so. I think, again, the freezing and then the threatened seizing of 300 billion plus of Russian assets held in Western debt instruments is an extremely dangerous precedent to be setting. We will soon be in the find out phase of what. And look, I think the passage of this new round of funding for Ukraine and Israel and Taiwan had buried in it a sort of legal precedent that the U.S. could, quote unquote, seize $5 billion worth of Russian assets. Look, most of these assets are in Europe. Europe is very reticent to do it. It's basically illegal. The rules-based international order, I guess the rules only apply to one side, and then so we shall see. But I think this is something to keep an eye on. I think if major Russian assets are seized, of course, Russia is in possession of roughly the same amount of Western assets in country, and they will just seize those in return. So we will accomplish nothing except we will destroy the reputation. In fact, in our view, it's a default. Like, we are defaulting on our debt obligations by seizing the Russian assets. Like, this is, to me, indistinguishable from default. Look, Putin is a monster. Putin is carpet bombing Ukraine. Putin is a war criminal. All those things would be true. And I certainly understand why people would believe them. You could convince us of those stance. But that doesn't mean that you have to shoot yourself in the foot, too, right? Like, we just don't seem to be, we play one-dimensional chess here. It just sort of boggles the mind.
Against the chess master.
Yeah,
so I'm going to throw a few numbers out at you in this question. Doomberg, the 4 to 5 decade mean for gold ownership is between 2 and 3%. At its height in 2008, it was more like 7 to 8%. Today, it's less than 0.5%. And that is with the highest non-wartime deficits our government has ever had, a $35 trillion debt pile to service that's crowding out other budget items, and inflation running hot for several years. So in your analysis, is there a time in the near future where the consumer wakes up and sees their purchasing power getting stolen from them through the debasement of the dollar and the pitiful state of owning bonds not being any better for promising future purchasing power protection, and they mean revert back to gold in a huge and swift way?
I don't know if it happens in the West. I know it's happening in the rest of the world. And I know I'm long an uncomfortable amount of gold. Basically, most of my liquidity is stored in gold for the exact reasons that you just articulated. And I hope I'm wrong. I mean, let's be very clear. Yeah. I do not want the price of gold to go to $10,000 an ounce. It's because the value of the US dollar, as measured in its ability to buy gold, will have shrunk faster than my total exposure to gold would be able to offset. Yeah. Because I still operate in the fiat world like you do. I own a home. I own, I pay my bills in dollars. I pay my taxes in dollars. We charge dollars for our subscription. Right. And so but I'm uncomfortably long gold for the reasons you just articulated. I hope that this is the one time in history where a currency is printed with reckless abandon and entitlement promises are made that can never be fulfilled, and debt increases at an exponential rate, and interest payments on said debt surpass the total defense spending of the country, and yet it all works out okay. And look, I'd be happy with that. But that's doesn't seem likely from where you and I stand today.
Seems a little unrealistic. Well, with everything we've discussed on gold, do you see the coming move in the gold price rivaling the 70s and early 2000 bull runs? And if so, clearly there'll be a massive sentiment shift. There'll have to be, from how the Western investor has viewed gold over the last 15 or so years. Do you see in any of your scenarios the sentiment shift creating basically a rising tide raises all boats scenario for the miners? So where I'm going with this, where basically we've seen this in other assets, including like Dogecoin, like you mentioned before, where as long as the stock contains the word gold in it, FOMO money flows into it. Do you see a FOMO situation at some point taking hold in the gold space?
I mean, look, anything's possible. It wouldn't be the base case for my thesis, especially on the miners, because you have management risk, which I'm sure you know. But by and large, there is a huge propaganda arm in the West against owning everybody's favorite pet rock. And the Western world is interested in a lower gold price because a runaway gold price is an inverse vote of confidence in the current fiat system.
Absolutely.
And so you're betting against the Fed. You're betting against the European Central Bank. You're betting against the powers that be in the world you currently live in, i.e. the Western world. If you're in Dubai, if you're in China, if you pick your favorite, if you're in Brazil, if you're in Japan, I mean, look at the yen price of gold. You know, it would have been a great hedge for you. But right now, here, there's a lot of, and look, it could happen if it does happen to be meaningful. Like, I get where you're going, and I understand your point, and it's well made. That is sort of upside gravy for, you know, third or fourth or fifth reason why we would own a lot of gold, not necessarily our base case.
I understand. Yeah, I understand. So silver's industrial application demand has exploded, and I can go through the litany of reasons why, but you know, the huge U.S. debt situation has even brought silver back into the discussion for some as a monetary metal, mostly in countries like China and India, and they have massive populations. Silver's been running supply deficits, and the gold to silver ratio is way higher than the historical mean. With all that as a backdrop, where do you stand with silver from an investment perspective?
So silver's a bit tricky because it is a hybrid. It is both the historical monetary metal, less so today, but also more importantly, an industrial metal, especially in the solar worlds, as I'm sure you know. And so you're beginning to see correlation between silver and the ESG movement, and we think we've just put in the peak in ESG, and that would be, all things being equal, relatively bearish for silver demand if solar doesn't grow at the rate at which the current discounted price of silver is projecting. Yeah, I think there's a high degree of overlap in the Venn diagram of people that want to buy silver who think ESG is BS. And so it's sort of a counterintuitive trade for some of these people. But I mean, I own some silver just for, again, liquidity in a grid down situation. I mean, I think I could trick people into thinking a tenth of an ounce of silver is worth a lot more than $3. But I only say that half jokingly. But by and large, it's not a market that we follow all that closely, except for we have an eye on the solar market and we understand there's significant industrial demand for silver in that regard. But I think if you're going to have an allocation to a monetary metal as a hedge against inflation, we would just do gold.
Okay, fair enough. I appreciate that. So with Doomberg, with the global push for electrification and infrastructure development, how is the global supply chain for copper coping? What challenges are anticipated there? And what is your, if you have one, a 1 to 3 year investment thesis on copper?
So copper has been a mystery because it has never actually believed the electrification hype. I mean, I don't think you'd see copper prices where they are if electrification were real, just given the degrading grades and the lack of new mines and the difficulty in getting new mines permitted. If the ESG, electrify everything movement were real and the market believed it, copper would be double where it is today, minimum, in an effort to stoke production. And so we've viewed copper not as an investment thesis, but as a window into the market's discounting of the probability of electric vehicles becoming a thing, of heat pumps becoming a thing, of, pick your favorite anti-fossil fuel, pro-electrify, everything movement. I think the market via copper, which is one of the oldest and most sophisticated markets in the world, right, is telling us that that's BS. It's not going to happen. You might see a little spike in nickel here and there, and lithium going off before coming back in, and so on. But copper has never really fell for the ESG message. If you looked at its chart and studied it long enough, I mean, it's become so hard to get a new copper mine off, even in the emerging world where you could get away with a few things. They're tightening. We're seeing economic nationalism in Peru and Chile and so on, and so we're seeing copper mines canceled in the U.S. You can't get a new copper mine done in the U.S. basically, and yet copper is just sort of there, right, doing its thing, relatively appreciated recently, but nowhere near what it would be if that movement were real. And that's one of the reasons why we're somewhat cautious on silver again, because like if you're going to do a lot of solar, you're going to need a lot of copper. Copper's not telling us we're going to need a lot of solar. So that's our view.
It's an interesting vantage point that you're bringing forth here. I've asked so many times, if the government and international statistics are to be believed, that we're going to have this major renaissance in EVs and we're going to put tens of millions or more vehicles on the road, why
it's not there?
Why are we not? Why didn't we invest 10 or 20 years ago in all the mining
that's
going to be needed to put those batteries in
well,
cars?
it can't happen because we haven't, and B, we didn't because nobody believed it.
Yeah, it's a fair vantage point. So copper is your litmus test on that movement. I love that.
Yeah, that's how we look at it.
Thank you for bringing that out. So here's a little bit of a different question, but in his recent Berkshire Hathaway conference, Warren Buffett, I'm sure you've heard this, he admitted that no one knows how to use the Berkshire's $189 billion cash pile effectively, mainly because things aren't attractive right now. So when you see the greatest investor of our lifetimes building up this type of historic cash pile, what does that make you think is coming for the markets, the economy, if anything?
A lot of respect for Warren Buffett and his track record, which is clearly far superior to both you and I. I think Warren Buffett sitting on a pile of cash would give me pause if I was going long equities today. And I think, sold half his Apple position, I think I saw, or some portion of his Apple position, and said nothing but great things about Apple. Look, if he thought Apple was a buy from here, he'd be buying it. The man has a multi-decade track record that is nearly unparalleled. I don't think it's replicable, so I don't think people should travel to Omaha to try to figure out how to be like Warren Buffett. If you want to be like Warren Buffett, buy Berkshire Hathaway stock. Set it and forget it. That far better outcome than you trying to do it on your own. But I would say it sort of runs counter to the inflation narrative, because he's just sitting presumably in short-term treasuries with that cash. If you truly thought the U.S. was going to hyperinflate, you'd be buying with debt companies that produce essential goods that will survive such episodes. But Warren Buffett's sitting in a pile of cash. Now, he has a problem you and I don't have, which is he can only invest in so many things because of the size of the investments he needs to make. Exactly. So he can't invest in private startups like I can and have it be a meaningful impact of my net worth. He needs to put billions to work. There, but by the grace of God go I. I mean, I would love to be able to be in a position where I can only put billions to work.
Right.
So I don't know that you can overread it for what the common person means. But if by the way, I think there are lots of reasons to sell Apple beyond just the general state of the stock market. I mean, they're not a growth company anymore. But him sitting on a giant pile of cash and not knowing what to do with it is generally, all things being equal, not very bullish for the stock market.
Yeah, I would agree. So, all right. So before we wrap up here, and I asked Doomberg our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all of the expert interviews that we conduct, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History nor Economics. This is a free gift. It's a must read for everyone on why we all should own gold. And it centers around a lot of what we've discussed today with Doomberg. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive this free gift on us. Also, I'm positive that you've enjoyed this conversation with Doomberg as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video. Doomberg, in wrapping up our discussion, my final question for you is about positioning, and it goes without saying that you're not a registered portfolio manager or investment advisor, but the folks still want to hear your perspective. I know that you've touched on gold. I know you've touched on some private equity investments, but in your view, what are some assets that you like and assets that you absolutely want to stay away from based on all the stuff that we've discussed today, from geopolitics to the debt load, et cetera?
So we are keenly interested in privately held companies that can leverage America's energy superpower status. So if you are a company that acquires your inputs, i.e. natural gas or NGLs in the US, but get to price your products on the global markets, you have a literal ticket to print cash today. That has been very interesting to us. We are structurally bullish nuclear. We do believe that the AI revolution is going to be the thing that normalizes nuclear power. The power of the tech lobby in the US is far, far stronger than the power of the environmental Malthusians who have successfully opposed the development of nuclear energy. Those are sectors that would be very interested in. But then, by and large, in the private world, the thing that matters most, and if you only do this for due diligence and stop there, is the quality of the CEO. That's all you really need. Winners win has been one of our philosophies, and that has served us quite well. And you don't really need all that great of an idea. You just need a rainmaker / show pony CEO who gets things done. And so you bet the jockey, not the horse, is another big philosophy of ours. So if, for example, you're perusing a series of junior miners to invest in, and you spend the time, which you would have to do, to adjudicate the quality of the management team, that would be the only parameter that matters. It matters more than ore. It matters more than grade. It matters more than state of permitting. Bet the team, bet the CEO. Do that over and over and over again, and you will integrate significant alpha over time.
That's outstanding. Doomberg, thank you for coming on to Metals and Miners and for being so generous with your time, your analysis, your ideas. It's been amazing to spend this time with you. Would you share with the audience any final thoughts you want to leave with those tuning in, where they can learn more about your work, and how they can connect with you?
Sure, Gary, the pleasure was all mine, and let's do it again as soon as you'll have us back. You can find all of our work at Doomberg.com. We have successfully ejected a squatter from that domain name, so we've launched our own website. You can find our newsletter, which we publish 7 to 8 times a month. We research, write, edit, publish, promote, and defend our pieces for a living now, which is what we do, and we love doing it. We also have our pro tier, a little bit of a more expensive tier, but you get a more in-depth access to the Doomberg team, and also we do monthly webinars, which are pretty insightful. And then also all of the podcasts that we appear on as guests are under our Doomcasts tab. We'll, of course, include a link to this one when it publishes. And so everything is at Doomberg.com. Gary, it's been fantastic. Congrats to you and the success of Metals and Miners. And I must say that the time flew by. It was a real pleasure.
Thank you. Thank you so much. I look forward to having you back on, Doomberg. Everybody, I'm going to put all of the links for this up on the screen for you and in the description. Go check out Doomberg. He is a wealth of knowledge and a very important follow. Thank you for being here with us, and everybody else, thank you for watching. I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History nor Economics. This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us.